take the discussion on markets forward with Vinay Paharia joining us today to discuss that. Vinay, good afternoon. Thank you very much for your time. What are you making of what's happening in risky assets? Not only India, but the global rally is playing out. And this in light with what, there is risk of second wave. Are the high frequency indicators, showing something which the main street is missing out on? What exactly is happening? Because the tug of war is on. Main Street and Wall Street are completely divorced right now, isn't it?
Well, thank you, Ajay, for inviting me to your show. So the reason why we are seeing most of the risky assets doing very well is because we have seen a deluge of liquidity being pumped in by global developed world central bankers. So if you look at the US Fed balance sheet, it has pumped in more money in the last 6 months than it has in the last 10 years. It's same is the case with most of the other developed world central banks. So all of this money is looking for yields. So if you look at US 10-year Treasury, it's already halved compared to where it was about 6-8 months back. If you look at India's bond yields, they have also substantially declined over the last few months. So all of this money is searching for yield, and it is finding itself into risky assets. And as you are very well aware, Indian equities and bonds are risky assets. Yeah.
Let me interrupt you over there. You are making a case that global liquidity is firing up risky assets. It may be very well true about global, indices and stocks, but where exactly is it getting captured in India? The SIP flow is shrinking, which is completely domestic, and the FII flows have not really gone through the roof. Is it possible that this liquidity may be making way to Indian large caps as well, but is not still getting captured by the data which we usually track?
Ajay, it is very difficult to pinpoint what kind of flows is getting into stocks and what is causing daily up or down moves. You can't simply track foreign flows and mutual fund flows to judge what can happen to stocks. What we generally tend to do is, it is difficult to just look at liquidity flows, technical flows. It's what is more important, and what is in our control is to look at what is happening to the underlying corporate fair values and then make investments based on such movements. So that is our GPS, so to say, to make all of the judgments, and that GPS has been fairly accurate till now. So for example, on a YTD basis, we have seen fair value of Nifty 50 companies fall by approximately 10%, and the markets, after all these swings and volatility, is now down by about 12% on a YTD basis.
Vinay, in fact, I do remember having this conversation with you offline last time round as well. You were making a case that, unlike popular belief, Indian equities indeed have come in attractive zone, not only because of the pure fall which has happened, but also because the macros, the way it has changed, interest rates, etc. How are you analyzing the valuations now, and what's the argument you're bringing forward right now?
So yes, one of the key factors which impacts equities is bond yields. So equity is one of the longest duration asset you can buy in the market today. And as you are very well aware of, if the long-term interest rates show a downward trend, that has a massive impact on equity valuations. So compared to where we were about a few months back, clearly the interest rates have remained downward, and the medium to long-term trajectory continues to remain soft, which makes us far more comfortable with valuation re-rating on an overall basis. So yes, there is clearly valuation tailwind because of falling interest rates in India.
Vinay, let's talk about the various sections of the market. I'm sure you guys are always poring over data, especially of the investable universe of, say, top 300, 400 companies, classifying them in market cap, sectors, their profitability profile, the kind of debt they are leverage they are, and debt they are servicing on. along with the outlook on how some of these companies will actually navigate the difficult terrain of collapse in top line right now. Talk to us about any of the such companies and promoters in the last couple of weeks.
Uh, Ajay, sorry, I was not able to hear your last part of your question. If you can please repeat that.
Sure. So I was saying that when you guys pour over data out of the companies, how they are, figuring, navigating the difficult environment, how their fundamentals are stacked up right now about the debt they need to service, their cash flows and top lines which have been badly hit. What is the section of the companies or kind of companies which will fare, well and are quite sound and sturdy to navigate this environment?
Oh, yes. Okay. So actually, what we have seen is in a lot of companies hitting the markets, both primary and secondary, for either debt offerings or equity offerings to strengthen their balance sheets in recent times. So we have seen some of the very well capitalized private sector banks also announce equity raise, and some of them are beefing up their balance sheets by raising long-term bonds, etc. So a lot of such companies which are envisaging some impact on their business are already improving their balance sheets. On the other hand, companies which do not get materially impacted by the ongoing pandemic, like companies in the IT sector, they are, or companies in the consumer staple sector, they are already debt-free, so their balance sheets remain. Yeah. We are actually seeing a reasonably good trend in corporate balance sheets, especially during the last few months.
Vinay, where are you taking contra calls right now, purely on valuation terms? Are there any spaces which may be out of favor right now, but provides you good valuation comfort, even if it's a dim outlook in the medium term?
So Ajay, what we have learned is that we should not be contrarian for the sake of being contrarian. Sometimes consensus may be right, and you want independent and their potential trends. So yes, there are a lot of calls which we are taking, which may not necessarily be contrarian, and which are sort of some of them are favored by the markets, but still we think there is a lot of potential in these companies in the future. So yes, we are not necessarily taking very contrarian calls in the current environment. We are positive on spaces like IT, healthcare and telecom, and we are underweight on spaces like consumer discretionary and financials, which are not necessarily contrarian.
And what are the macro high frequency indicators which are there on top of your radar, which you are watching very closely to to gauge how the recovery or the growth will be?
There are a host of high frequency indicators which do keep coming in, like for example the PMI data, like for example the electricity consumption, the automobile sales, so on and so forth. And we are keenly watching a lot of them. But Ajay, we need to remember one thing for sure, that most of these indicators are going to remain soft for some more time, and they will only gradually recover. So as someone rightly mentioned, that do not measure unemployment on Sundays. So we know that for sure that this is a bad time, and some of these indicators are going to dip temporarily, and they are going to gradually come back to normalcy. So we are not particularly very anxious about some of them, and not making any hasty calls on the investment front, which are of course driven by medium to long-term outlook on companies. So we think that medium to long-term outlooks are not materially changing, and the near-term indicators are bound to remain soft and only gradually improve.
All right, Vinay, we'll let you